welcome to another edition of Trust Issues by Kepler Trust Intelligence. In this podcast, we speak to leading investment trust managers about the philosophy behind their strategies and the themes shaping their portfolios. In today's episode, we're joined by Emily Fletcher, manager of BlackRock Frontiers, to explore where she's finding opportunity across frontier and emerging markets. So Emily, many thanks for joining us today.
It's great to be here. Thank you so much for having me.
So to kick things off, could you outline your investable universe and explain how BlackRock Frontiers differs from a typical emerging markets fund?
Of course, thanks so much. So if you think about the world, you have developed markets, there's about 20 to 25 developed markets. Then you have really the rest of the world as we would see it, and the difference being that in the developed world, you have strength of institution, you have normally democratically elected governments. In emerging markets, I think, or frontier markets, I think what really defines them is that likely all of that is much less. So you may not have democratically elected governments. You probably don't have as strong institutions as you have in the West. But to talk about our universe, within emerging markets, there's about 25 countries as defined by MSCI. Of those, the top 8 represent around 85 to 90% of that MSCI Emerging Markets Index. Now, those top, 7, not 8, largest countries are China, India, Korea, Taiwan, South Africa, Brazil, and Mexico. And we don't invest in any of those. So we take out about 85 to 90%, as I said, of the MSCI Emerging Markets Index. And then we would invest in all the smaller countries than that, sort of anywhere globally. So we invest in countries that are both the smaller emerging market countries that are defined as frontier market countries, and then any standalone indices as well would also be included in our universe. So it's quite a broad and global universe, and it typically tends to be a universe where people really have very minimal exposure in their portfolios, and a universe that we think is really under-researched and under-covered and and not really looked at by global analysts.
Fantastic. And what would you say BRFI offers for investors looking for genuine diversification in their portfolios?
Well, actually, I think BRFI can offer quite an interesting source of diversification. And there's a couple of reasons for that. The first is just going back to what I just said, that I think it is really not held in investors' portfolios in the main, in aggregate, in meaningful size. Because about 85% of the MSCI Emerging Markets Index is in those top 7 largest countries, I think it tends to be where emerging market portfolios are therefore invested, where they're concentrated, where a lot of focus is spent. And so therefore, some of these smaller markets tend to move a little bit differently. So they don't necessarily go up or down on the same day as, China's going up or down, or the US is going up or down. They are a little bit more diversified. We would say they have lower correlation between them. They don't necessarily move in exactly the same way. And that's really interesting because you do therefore have this potential source of diversification for portfolios. If we take a step back to think about why is it that some of these smaller countries could be quite uncorrelated to what we see happening in larger markets, I think it can start to make sense. They have different drivers. Markets tend to be driven by more idiosyncratic political events, idiosyncratic domestic economic events. Therefore, they just have these lower correlations. And yeah, as you said, you can get that diversification.
And coming back to something you touched on earlier, how do you go about sourcing and researching opportunities in perhaps less efficient markets?
So it's really important, as I said, when you're looking at countries where the drivers are idiosyncratic, they're domestic, they're about what's happening in country. I think it's really important to spend time visiting countries, spend time on the ground, really building relationships, trying to really understand what's happening in their context and in their environment. So we do spend a lot of time traveling. I think it's been a real benefit for us where we sit now, the history of having run this trust for the last 15 years. And so we have been traveling to these countries, for quite an extended period in a team that's been very stable over that time. So sadly, I'm going to give away my age by saying that I've been at BlackRock for nearly 20 years. Right. And Sam, my co-manager, has been there for just over 25 years. And the majority of our team actually started at BlackRock and started as grads as well. So actually there's a lot of collective experience that I think is really important to build up. But I think it's also important to say that when we travel, we do have to try and build those networks in country to really understand what's going on. So you not only meet with a company, but we'll meet with their competitors, their suppliers. We'll try and meet with development institutions. We'll try and meet with central bank representatives. We often try and meet with a group of students, to really understand sort of different outlooks, perspectives, try and get a feel of, what are the things that are important within that domestic context, because those idiosyncratic drivers are so much more important in each individual country.
And touching on one of the hot topics of 2025, how do you go about approaching geopolitical risk, particularly trade tensions and tariffs? And how effectively have countries managed to navigate somewhat of a middle ground between East and West?
So 2025 was a year of surprises on geopolitical front, and I think 2026 will be too. I think the first thing to say is that not only 2025 and 2026, but actually since we launched in 2010, 3 months before the Arab Spring, that it's a comment we've been able to make most Januaries about the previous year in these countries, that it has been a year of, various hot topics of geopolitical risk. And that, going back to my initial comment of, what is our universe, actually, I think that's really what differentiates these smaller markets from developed markets. That isn't that strength of institution, either on the economic side or the political side. That's why they're classified as emerging and frontier countries. So it's really important, I think, to understand the context, to spend time on the ground. And the other thing is we do run a global portfolio. So this isn't a single country fund in any way, and that means that these risks are diversified across multiple countries. Going back to the correlation point, it's actually not just emerging and frontier countries versus developed markets that have low correlations, but actually all of these countries have quite low correlations to each other. Because the drivers are predominantly domestic, because they're predominantly sort of idiosyncratic to that country, they're not really the same. And example we often use is taking sort of Bangladesh on one side and Chile on the other. If you were to think about Chile, what drives its country and its economy, Chile's recently had elections. That's a focus. Relationship with surrounding countries. Well, that would be sort of Argentina, Brazil, US probably. Then you'd probably think about sort of what drives their economy. Actually, they're a big copper exporter, a bit of gold. It's a very, very urbanized country. It's a very, very well educated country. That's Chile. On the other hand, if you go to Bangladesh, it's got a very, very large population. It's actually fairly small for that population in terms of land area. Things they're talking about probably focused on the recent change of government away from Sheikh Hasina, who was in place for an extremely long time. Currently have a caretaker government. They will go into elections, but we're talking about there not whether it's between left or right, whether or not the Islamic Party, Jamaat Islamiyah, does very well. In terms of their major exports, it's probably textiles. Countries that they're most concerned about relationships probably be with India, Pakistan, maybe China. So you can see there's just very little correlation between the things I've mentioned for each country. If you were to ask most people in Chile if they could place Bangladesh on the map, I don't know how many could. And, similarly, if you ask the population of Bangladesh where Chile was, there's no real trade that we're aware of between the two countries, no real political contact between the two countries. The two are just moving in very different spheres, I think it's fair to say. So when you think about that, the benefits of a global portfolio are that you have different things doing different things. Different countries doing different things. And actually, for us, when you aggregate that together, you end up with our universe actually has a lower volatility than the S&P 500. Our benchmark has a lower volatility than the S&P 500, which is a kind of mind-boggling stat that could be true. But that lack of correlation between the countries is the reason for it. So yes, going into 2026, there will be factors that we will be discussing around geopolitical risk in different countries and different regions. Trade tensions and tariffs, very much a topic in 2025. I think our countries have navigated it well, but it could very much return in 2026. Obviously there, I think the real question is the differential application, and how countries compete, versus others. So if you get very differential tariffs put in place, I think that's when you can get issues from that, which is I think we've moved away from slightly, but it definitely could return as a topic. And then you talked about sort of navigating a middle ground between East and West. And here's where actually I think the universe that we look at actually is fairly well positioned going into 2026. I think we will continue to see tensions at a split between East and West. And what we have is a universe, I think, of countries which in the main have been able to maintain trade relationships with both sides, politically are trying to sit in a more neutral ground in the middle. And I think there's a couple of areas in which that has been and will continue to be a benefit. The first of those being for a region like Southeast Asia. I think they have attracted FDI for manufacturing, and I think they will continue to see some growth in their share of manufacturing exports. You've seen that with some technology companies diversifying production away from Taiwan into Thailand, into Malaysia, into Vietnam. I think that's likely to continue. And then the other region I think that has benefited and will continue to benefit will be the GCC, where I think we have seen the UAE particularly really emerge as a place where people are prepared or want to store their wealth, kind of a new Switzerland or Switzerland for emerging economies. And I think that's been very beneficial for house prices, real estate there, and propped up and driven some of the growth in that region. So I think a couple of areas that will continue to benefit. There will, I'm sure, be losers on the other side, but navigating that, being aware of that is really just day-to-day bread and butter, I think, when you're looking at a portfolio in this region.
Thank you. Very comprehensive answer to that question. And liquidity is also often cited as a challenge in frontier markets. So how do you go about managing this in practice?
Thanks. Well, we actually believe that the investment trust structure is just really ideal for looking at this universe because of its closed-ended nature. We would recommend to investors that looking at these selection of countries that you do take a 3 to 5 year time horizon in making that investment. And we believe that the closed-end nature allows us to look at our investments on a similar time horizon. So these markets tend to be less liquid than what you would see in more developed markets. And again, so that allows us to invest sort of exactly where we want, not have to hold things for sort of reasons of liquidity. And we don't run an open-ended fund alongside because we think this structure is perfect. At the same time, I would say that, everything in our portfolio is listed. These tend to be fairly mainstream companies that we hold in their own countries. It's just that the countries are more unusual. And typically everything in our portfolio trades more than $1 million a day. There will be a few exceptions to that. That's the benefit of the trust structure. But if you have a Bloomberg terminal, everything is trading normally. You can value the portfolio in 10 seconds. So it's not really taking that closed-ended nature to any extreme at all. It's just allowing us to have those longer duration views.
Great. And moving on to performance next, the trust has had a very strong year. What have been the main drivers, and have there been any surprises along the way?
Yeah, so we did have a good year in 2025. There are a couple of countries that did really well within that. I think the one to really mention would be Pakistan and the exposure that we had there, where I think the market was up more than 100% over the year in 2025 in aggregate. So sort of anything there did pretty well in Pakistan. I think what is great, but maybe somewhat surprising about that is just the extent of that movement that we saw in the market. This was already on the back of a very, very strong 2024. Pakistan did have to go to the IMF in order to help them reset government finances post-COVID. And it's, I think, interesting. It's great they got that in place, and we're very much seen an improvement in sort of government deleveraging, and that's benefiting the population. But I think what's really surprising is the scale of the move, because I think since we've launched in 2010, I think we have consistently said that we have a universe where we see really interesting growth opportunities. There's a huge mismatch between this area of the world representing something like 34% of the world's population, but something like 3 basis points in MSCI ACWI. There's a huge divergence there that presents so many opportunities for growth. But at the same time, we continue to see companies trading on the lowest valuations globally. And at the moment, I would say really cheap valuations, absolute cheap relative to their own history, cheap relative to the rest of the world. And that dichotomy, I think, has persisted for quite an extended period. So, what's really surprising is when you get a market like Pakistan that can do 100% in 2025, having already had a good year in 2024, it just shows that they're actually, at some point, these markets do re-rate. And at the point when they start to re-rate, stock is not available because of the less liquid nature of these markets.
And how important is income to total returns?
Yeah, so the income that we have in the trust actually is really just a natural consequence of us owning companies that are cheap, I think. So right. We own companies. In some markets, there's more of a history of paying dividends. In some markets, there's less of a history of paying dividends. It doesn't tend to be for anything other than cultural reasons, I think, as to really why that is. But we're not an income-seeking trust, but a consequence of the companies that we own that tend to pay quite good yields, we just pass on that yield to investors, is that the trust has a very good yield on it. So it has been an interesting portion of returns. And actually, I think there are instances in our portfolio where, going back to that question of, what is it that really causes your markets to re-rate? Actually, there's some instances. I can never really answer that question extremely well because I think catalysts are only obvious in hindsight. But I think there's instances where it doesn't matter. We own a bank, for example, in our portfolio that's trading on just under 4 times PE with a 16% dividend yield. Kind of at that amount, that valuation, if it just sits there for the year and you collect the coupon and it doesn't derate, that's sufficient to get quite an interesting return. So that's when I say I think it can really matter. Other end of the spectrum, we have companies that pay minimal yields as well, and that we hold expecting a re-rating. So it can be meaningful. I think it has been meaningful over the life of the trust, but we would love it to re-rate and dividend to be a less important component of returns as well.
Great. I'd like to focus on the portfolio next. Saudi Arabia and the UAE currently have a significant weighting. So could you talk us through the investment case here?
Yeah, sure. Saudi Arabia is the largest absolute country holding that we have in our portfolio. It's also our largest underweight relative to the index. But to talk about it in the absolute sense, why do we hold companies in Saudi Arabia? It's I think just it's quite a diverse market, and we find opportunities there that I think are really benefiting from the extent of the changes that we've seen. In the 15 years we've been running this trust, the country that has seen the largest social change is Saudi Arabia. And the changes in terms of development of cities and some of the social changes that got through are just really phenomenal. I think that they can happen in that sort of period of time. And as a result of that, we just see some really interesting companies where we're seeing for example, sort of regulatory change, we're seeing consolidation, we're seeing margin gains. It's very much sort of stock-specific opportunities that we find in that country. Sort of a result of some of the changes, it just really throws up some really interesting companies. We're seeing sort of push towards greater insurance coverage, just really, really just a continuation, I think, of those structural changes in Saudi is bringing up quite a lot of opportunities. So that's the sort of company or theme that we're invested in that country. UAE that you also mentioned, very much sort of different end of the spectrum. I think it goes back to what we were talking about in terms of geopolitical fragmentation globally that actually comes at the benefit of the GCC. Although there are still very much some conflict areas within the Middle East, I think actually for some of the larger economies, we have more stability there than we've seen at any point over the last 15 years. Any talk about a normalization in relations between Saudi and Israel, if that were to happen at some point in the future, it is mind-blowing in terms of the level of change, I think, versus, as I said, us launching the trust 3 months before the Arab Spring. So I think it is throwing up opportunities, as I said, very much sort of real estate, banking, economy growing and sort of benefiting from that in the UAE. And so our positions there would be really around that theme. But it's probably worth also sort of throwing in other large countries that we have. We've got exposure in Egypt, for example, that we really think has got to the point where there's been quite significant economic reset, both currency devaluation. We're starting to see some really interesting opportunities in fintech, I think, emerging there. We've got exposure in Eastern Europe. I think the region as a whole really benefiting from just outsourcing from Western Europe to Eastern Europe. It's something that's been going on for probably 25 years now. But I think still a very structural growth driver to some of the economies in Eastern Europe. And of course, benefiting in Southeast Asia, I think, as well, from some of the, again, some digitization strategies, really just starting to drive growth. And I think reached the point where sort of finally post-COVID, we're starting to see a bit of an acceleration in economic activity, driving some growth as well.
How would you characterise a balance between export-led growth and domestic consumption in emerging and frontier markets?
Yeah, thank you. That's a really interesting question. I'm gonna flip it slightly and say, actually, I think there's something like 10 sectors for MSCI globally. I think there's 2 of them that are really, really global sectors, and the remainder are domestic sectors. So I think if you talk about sort of energy or materials, those we would consider as really global sectors. So your commodity price, your oil price is going to be a global driver. It's going to be pretty much the same everywhere. And that's going to really determine what's happening in those sectors and in the companies there. Within our universe, for all the other sectors, basically exposure is domestic. And that, I think, is a little bit different, again, probably to more developed markets where, if you think about the big banks of the world, they're all very much doing the same thing, whether they're listed in sort of Europe or the US. If you come down to looking at sort of banks in, I don't know, Pakistan or Philippines or Chile, then you're looking at really what's happening in their domestic economy. They tend to not even have exposure sort of cross-border. So that, I think, is quite a point of difference. So therefore, I would say majority of what we're focused on is around what's happening domestically in each of these countries, more than what's happening in the export sectors. And the exports for us tends to be in those global commodity sectors.
You've also increased exposure to smaller emerging and frontier markets. What's behind this shift?
Sure, yeah. So in terms of particularly the exposure that we've increased to the smaller countries, so that would be countries such as Egypt, Pakistan, Turkey, Bangladesh, that we've been increasing exposure to. Actually, it's something we've been doing for about the last 18 months in terms of increasing exposure there. I think the easiest way to sort of summarize them collectively, because again, the problem is it's always quite domestic and quite idiosyncratic, but I think the easiest way to summarize them together is that post-COVID, a lot of these smaller countries were in a position where the government was over-levered and households were over-levered, just given the drop in economic activity that happened in that time period. And that took quite a long time to reset. Obviously, government resetting finances tends to mean a sort of austerity, which weighs on growth. And households, resetting their balance sheets, again, tends to mean less spending, and, that results in less growth. So I think having reached the point where we've seen quite a reset in both of those, we're now at the point where inflation's come down very significantly globally. In almost all of our universe, it's below historic levels. Interest rates have actually still at quite high levels, but are starting to be cut. And as those real rates are coming down pretty much in all of these smaller countries, at the same time as having seen balance sheets quite significantly reset on sort of household and government levels, we are now starting to see economic activity acceleration. And I think for us, if we can anticipate that we will see a greater pickup in acceleration in growth. So really looking for kind of that second derivative. Actually, we believe that tends to be, if you can anticipate that, the time when you see markets really respond and really start to do well. So you want to be there sort of in anticipation of that. And that's why we started moving the portfolio into some of those smaller countries sort of 18 months ago. And
what are your thoughts on current valuations across the universe?
Yeah, thanks. So I think valuations continue to look really cheap and really interesting across our universe. I did already say that valuations are cheap on an absolute sense. I think that the valuation on our universe is something like 8 to 9 times PE. And that's quite a significant discount versus its history. Despite the fact actually that we've coming off the back of a 2025 where some of these countries did start to do quite well. And again, I think that kind of speaks to sort of the earnings acceleration that we're talking about and expecting to come through in 2026 versus 2025. So I think valuations continue to look very attractive across this universe. Obviously, with the caveat that, a sort of aggregate PE kind of means nothing. You probably have something on 1,000 and something on 1, and you sort of put them together and come up with an average in the middle. But we do think that we can continue to find attractively valued companies in our universe where we have a differentiated investment case versus what the market expects.
And one final question, if we may. What do you see as the key drivers of equity market performance over the next 12 months?
Thank you. Yeah, something that will be talking about probably in a year's time that I have utterly not foreseen in all likelihood, because that's the way markets work. I think for us over the next year, a continuation of the current environment whereby we have had, I think, good enough global growth, no COVID level style shocks, get something like that. I think bets are off the table, but, no GFC, no COVID level style shocks, fairly benign background. I think in that environment, it's a good setup for emerging and frontier markets going into 2026.
Great, perfect place, I think, to wrap up today's discussions. You can visit the BlackRock website to find out more information about the trust. You can also find our latest research note on the Kepler Trust Intelligence website. Many thanks to Emily for joining us today, and we hope you join us again soon for another edition of Trust Issues. Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorised and regulated by the Financial Conduct Authority.